Can you cash out of a Delaware Statutory Trust? A Delaware Statutory Trust, DST, is meant to be a longer-term investment with around 5 to 7 years holding periods. Investing in a DST generally means you won't need access to those funds for a while. But what happens if you do? Are those funds locked in for the full duration of the holding period? Not exactly. DST investors do have options when it comes to cashing out early. We'll discuss those options and what happens for investors who hold for the full investment duration. Exiting a Delaware Statutory Trust early. Can you cash out of a DST early? Yes, it is possible to cash out of a Delaware Statutory Trust, but it may not be easy. DSTs are illiquid investments, so it may be difficult to find a buyer for your interest. If you do find a buyer, you may have to sell your interest at a discount. Those investors who go ahead with exiting early anyway have a couple of options. They can take the cash, which creates a taxable event. In addition to federal and state taxes, the depreciation recapture tax, 25%, and the Medicare surtax, 3.8%, will be applicable. Besides taking the cash, investors can do a 1031 into another eligible like-kind property or DST. A 721 exchange may also be an option. Note that these options are also available to those who hold until the end of the investment period. Whether an investor exits earlier or stays for the duration of the investment, early exit strategies should always be explored before investing in a DST. Early exit options can vary from DST to DST. Cashing out on the exit date. Holding the DST until the exit date published by the sponsor is called holding the DST for its full investment cycle. At the end of the investment cycle, most or all of the properties in the DST will have been sold, so the investment comes to an end. Like the early exit investor, those holding for the full duration must decide whether to keep the cash or continue deferring gains. Keeping the cash creates a taxable event. However, those gains may be taxed at the long-term capital gains rate. Also note the additional taxes previously mentioned may apply as well. If the investor wants to continue deferring gains, they can do a 1031 exchange into another DST, real property, or a 721 exchange. Gains will continue to defer until the investor sells their investment. Investors not wanting to manage rentals may consider returning to another DST versus real property. Cashing out of a DST does involve tax implications. It's best to work with a tax specialist to fully understand those implications. Realized can help you create a strategy to make your lifestyle goals a reality. For more, please visit the links in the description. Thanks for listening.